When people look at their credit reports, they often focus on the score displayed at the top of the page. But the real substance of a credit report lies in something called trade lines. Trade lines are the individual credit accounts listed in the report, and each trade line represents a financial relationship between a consumer and a lender. Understanding how trade lines work is one of the most important steps in learning how credit reports are interpreted, because trade lines form the foundation of the credit profile lenders analyze when evaluating risk. Every trade line contains detailed information about a specific account, including when the account was opened, the type of credit involved, the original loan amount or credit limit, the current balance being reported, and the payment history associated with the account. These details create a timeline that shows how the account has been managed over time. When lenders review a credit report, they study these trade lines carefully because they reveal patterns in financial behavior. For example, a trade line may show that an account has been open for several years with a consistent history of on-time payments. That pattern suggests reliability because it demonstrates that the borrower has managed the account responsibly over a long period of time. In contrast, another trade line may reveal missed payments, rising balances, or irregular payment activity. These patterns may indicate financial stress or instability. Because trade lines record month-by-month activity, they provide a detailed picture of how credit has been used rather than simply showing a snapshot of the current balance. Another important aspect of trade lines is the type of credit they represent. Some trade lines represent revolving credit accounts such as credit cards. Revolving accounts allow the borrower to repeatedly borrow and repay funds within a set credit limit. Other trade lines represent installment loans such as auto loans, student loans, or mortgages. Installment loans involve borrowing a specific amount and repaying it through scheduled payments over time. Lenders reviewing a credit report often pay attention to the mix of trade lines because different types of credit demonstrate different financial behaviors. A profile containing both revolving and installment accounts may indicate that the borrower has experience managing multiple types of financial obligations. Trade lines also reveal credit utilization, which describes how much of the available credit is being used relative to the credit limit. For example, if a credit card has a limit of $10,000 and the reported balance is $2,000, the utilization rate would be 20%. Lower utilization often signals responsible credit management because it shows that the borrower is not heavily dependent on available credit. Higher utilization may suggest financial pressure because it indicates that a large portion of available credit is already in use. Lenders frequently analyze utilization patterns across trade lines when evaluating credit applications. Another element trade lines display is account status. The status may indicate whether the account is currently open and active, closed, paid as agreed, or in some form of delinquency. This information helps lenders understand the current condition of each financial relationship listed in the report. For instance, an account marked as paid as agreed signals that the borrower fulfilled the terms of the credit agreement. On the other hand, an account marked as late or charged off may indicate that payments were not made according to the agreement. These status indicators allow lenders to quickly identify accounts that require closer attention during the review process. Trade lines also contain payment history grids that show whether each monthly payment was made on time. Over time, these grids create a visible timeline that shows how consistently obligations have been handled. Consistent on-time payments across multiple trade lines often signal reliability because they demonstrate a pattern of responsible financial behavior. When lenders evaluate credit reports, they often look for these patterns across the entire set of trade lines rather than focusing on a single account. Within the credit strategy framework, analyzing trade lines helps consumers understand how lenders interpret credit reports. Instead of reacting emotionally to one negative account, individuals can step back and observe how each trade line contributes to the overall profile. A report containing several positive trade lines may still appear stable even if one account reflects past difficulty. Conversely, multiple negative trade lines appearing within a short period may indicate broader financial stress. By studying trade lines as part of a larger pattern, consumers gain the ability to interpret their credit profiles with greater clarity. Understanding trade lines also helps explain how credit reports evolve over time. Each month, lenders report updates to the credit bureaus reflecting new balances and payment activity. These updates modify the trade lines within the report, and gradually expand the timeline of financial behavior recorded in the profile. As time passes, older entries may become less influential while new activity becomes more important. This gradual evolution is why credit reports are often described as living financial histories rather than static documents. Each trade line represents a chapter within that history, and together they form the narrative lenders review when deciding whether to extend credit. Learning how to interpret trade lines therefore provides valuable insight into how credit decisions are made and why the structure of the credit report matters when analyzing financial behavior.